Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and today we are talking about commodities, and in particular iron ore and energy, which have both suffered badly over the last year or so. With me is Tim Carleton from Auscap Asset Management and Steve Johnson from Forager. Welcome, gentlemen.
Thanks.
Let's start with you, Steve. Iron ore in particular, Australia's biggest export, was at decade highs going back a couple of years, and it's been a steady, if not accelerating, decline. Where do you see the market at the moment?
All-time highs, I'd say. I'm pretty pessimistic on the outlook for China, and I think we're going to have a massively oversupplied market for 10, 15 or maybe 20 years, right. So not particularly optimistic about seeing a turnaround in that particular commodity.
Price target?
Don't have one, but a price target that sends a lot of people out of business. Right. Whatever it is, it needs to send supply capacity out of the market, and I'm surprised we haven't seen more yet. In terms of the BC Irons of the world, they're having some very difficult conversations, I would say, around the boardroom tables now about what to do about those high-cost mining businesses.
And Tim, you've written and spoken about iron ore quite a bit, and you've got a fairly clear view. Does it go a lot lower, and do companies go broke before we see a bounce in the iron ore price?
I think it's likely. I mean, I agree with Steve. At the moment, it's a demand-supply imbalance. You're not going to get a response from the demand side. Demand in both the energy and iron ore markets typically grows quite slowly. In fact, if we take out China, the demand for steel, which drives iron ore and coal demand, has been growing about 1% per annum for the last 40 years. So it's very unlikely now that China's growing at those sort of rates, and likely, if anything, to slow further rather than to accelerate, that you get any sort of demand response that puts the demand and supply equation back in balance. So it's waiting for the supply response, because supply is far exceeding demand at the moment.
Well, instead of talking about price, let's talk about supply. Now, there's a suggestion that some of the smaller players will eventually close down. What about we go up a notch? Fortescue, Andrew Forrester's play, just sitting below the majors, seems like it's struggling at these prices. Do you think it makes it?
Well, I think the small guys don't have sufficient supply to put, even if they go out of the market, to put the market back into balance.
Right.
So at some point, either price will correct to a level where there will be pressure on the majors to reduce their supply. To be honest, I think that's probably the base case, in which case there's still downside, because the market doesn't have any consideration for sunk capital costs. So everyone's going to continue to produce until they're making a cash operating loss. Mm-hmm. And that's why less supplies come out of the market than we might have expected at these sort of prices. So that probably continues until the companies that are making cash losses are actually exiting the market and putting the demand and supply equation back into balance.
And I think with Fortescue, there's a price at which they're making a cash profit on production, at which the mine probably stays open, but it's not enough to service and repay $8 billion of debt. So there is a case there where that entity goes out of business, but that the mine keeps operating until the iron ore price falls even further. Right,
so it's going to be tough for Fortescue by the sounds of it. Let's switch to energy, and in particular oil. Once again, if you go back to pre-GFC, it was $149. Goldman Sachs said it was going to $200 a barrel. Dropped, then bounced back and stayed there, and all of a sudden it's just fallen out of bed with extra production coming out of the US. Do you think we've found the bottom there?
I have quite a different view on oil, and we've actually been adding some oil exposure to the portfolio because I think that supply response is going to be much quicker, and the supply-demand imbalance is nowhere near as big. We're looking at 1, 2, at most 3% in terms of the amount by which that market is oversupplied. That doesn't stop the price going lower in the short term. I don't really have a strong view about how low it will go, but I think 12, 18, definitely 24 months down the track, we'll see a higher oil price than today. There are still new resources that need to be developed in that market, and they are not going to get developed at a 40-something oil price.
And Tim, do you think the supply-demand equation can fix quicker, as Steve's saying, and that oil will find a base and climb at some stage in the medium term?
To be honest, I'm not sure. It's not something that we ever try to predict in terms of where the prices are going to go. We try to analyse the existing situation. At the moment, you've actually got supply continuing to increase. It's increasing at a slower rate, but it's actually still increasing. And that's at a time when you have global crude inventories at all-time highs since they started recording data in 1982. That's not an environment in which you're likely to see much of a price response. So I think everyone would like the oil price to go, well, certainly the oil producers would like the oil price to go higher. We can't see that happening in the short to medium term until you actually start to see a supply response. And again, it's not happening because the cash costs of production are lower than the spot price for the vast majority of players. They've sunk a massive amount of capital into developing the oil production they're currently producing, but their cash costs for running the existing operations is still sub the current price. And that's why you're not seeing a supply response. And that's unlikely to happen, I suspect, until a lot of these businesses are making cash losses.
Okay, so stay away from iron ore and maybe start to dust off your files on oil stocks.